Palladium surged. Get this, 12.40% today.
An unbelievable move. Just massive, closing right near $2,000 an ounce.
And that explosive action, I think we can agree, is the real story for December 26th.
Absolutely. Because while the S&P 500 looked, perfectly tranquil,
Right, totally calm.
the real money was being made and lost in this dramatic split-screen commodity market.
That divergence is everything today. The
Yeah.
major equity indices, they barely moved. The S&P slipped just, what, 0.03%?
Exactly. But if you looked underneath that surface, you saw structural change, geopolitical anxiety.
Yeah.
Just chaos, battling it out in the commodity pits.
So this great commodity divergence that people have been talking about,
Hmm.
today it just went into overdrive.
It reached an extreme state, yeah.
Okay, so let's unpack this metals melt up. This wasn't just gold continuing its run. This was, it felt like a coordinated surge across the whole complex.
It really did.
When we see numbers like this, especially so late in the year, what's the core driver? Is it fear or is it fundamentals?
It's both, and that's what makes this so fascinating.
Okay.
The strength tells you there's a flight to safety. That's the classic haven behavior. But there's also this persistent, genuine, structural industrial demand that the supply side just can't keep up with.
Right, so take silver.
Perfect example. It surged 9.05% today, closed right near $80 at $79.20.
That's one of its biggest single-day moves in years. It just screams underlying tension.
And silver is the perfect canary here because it has that unique dual personality.
It's a monetary asset, sure, but it's also absolutely critical for the future economy.
Exactly. When silver moves like this, we have to look at its industrial role. And today's data, it just points to persistent demand from sectors that are not slowing down.
Like solar panels, EVs.
Solar, electric vehicles, AI data centers, 5G infrastructure. And critically, physical supply of silver has failed to meet industrial demand for 5 straight years.
5 years. Wow.
So that supply tightness, you couple it with all the geopolitical noise we've been hearing, and it's just forcing prices into this new regime.
And then there's gold, which has been the reliable superstar all year. It just keeps climbing.
Gold was up another 1.17% to $4,533.40. What's just incredible here is that gold is now on track for its best annual performance since 1979.
1979.
This isn't just speculative froth. This is central banks. We saw reports of about 220 tons purchased in Q3 alone. And yes, those ongoing geopolitical flashpoints.
Everything from the Venezuela blockade to, the conflicts in Eastern Europe, it's just constant support.
Constant. But what I find really compelling is that the industrial commodities, the things that tell us about the real economy, they joined the party today too.
They absolutely did. Copper. That number was staggering.
It spiked 6.23% to $5.84. That's a 5-month high.
And the narrative there is different, right? It's less about a safe haven and more about real-world supply and demand.
Exactly. It's about supply-side destruction meeting energy transition demand. We are seeing the painful results of years of underinvestment in mining, mine outages, and this is key, major Chinese smelters are planning substantial output reductions for 2026.
How substantial?
Over 10%. This isn't a short-term trade. This is the market pricing in a multi-year supply bottleneck.
So on one side, you have metals just exploding from demand and supply cuts. And then you look across the aisle to energy. And it's the polar opposite.
It is a profound market divergence. WTI crude, the U.S. benchmark, tumbled 2.43% today, down to $56.93.
And importantly, it fell further below its moving averages.
Decisively below both its 50-day and 200-day. That's a major technical warning sign. And natural gas, it had an even worse day.
Down, what, 8%?
Plunged 8.63% to $3.88.
A move like that in nat gas this late in the year, that's unusual. Is this just about warm weather or something else going on?
The fundamental backdrop is just persistently bearish. It's not just seasonal. You've got OPEC plus pausing production increments all the way through March 2026.
Right.
You've got continued inventory builds globally, and the EIA is forecasting Brent crude will average a much lower $55 in the first quarter of 2026.
So the fundamental is just a heavy weight on the price.
A very heavy weight. And you add to that the concern about weakening Chinese demand, maybe approaching peak oil consumption, and you just have a solid ceiling on prices.
And we can see this commodity split reflected perfectly in the equity sectors today. Materials, on the back of that metal strength, led everything, up 0.59%.
While energy was the second worst performer, it lagged significantly at negative 0.38%.
That's the market voting on the commodity divergence right there in the sector performance.
That split is highly unusual. It tells you the market is grappling with two completely competing narratives.
Are we heading for a manufacturing-led inflation period because of material scarcity?
Or are we staring down weak growth and a glut of energy? Today, the metal side won that debate decisively.
All right, let's pivot away from the commodity chaos for a moment and look at the stock market.
Okay.
The major indices, as we said, gave this impression of total calm. The S&P 500 slipped only 0.03%. It even touched a fresh all-time intraday high of $6,945.77. If I only looked at the headline, I'd assume it was a quiet, boring day. But the underlying signals felt, well, they felt distinctly cautionary.
You have to look beneath the surface, especially when liquidity is this thin.
And volumes were low today.
Very low, running about 50% below their 30-day averages. That means any subtle positioning moves get amplified. And the first worrying signal starts with the small caps.
Explain that. If the large cap S&P is near its all-time high, why does a move in the small companies matter so much to the overall risk picture?
Because it signals a deterioration in market breadth and a shift in positioning. The Russell 2000, that small cap index, it declined 0.54% today.
Okay.
So that gives us a negative 0.51% spread versus the S&P 500. This is a classic risk-off move. Investors are choosing large cap quality and stability over the smaller, riskier names.
Which is strange because, we've had 75 basis points of rate cuts this year.
Exactly. The Fed funds rate is down to 3.50% to 3.75%, but the small caps aren't capitalizing on that easier environment. That tells you the risk appetite is just waning at the margins.
And the internal data, the breadth, that confirms the story.
It does. The market internals showed clear weakness. The advanced decline ratio, it plummeted to 0.68.
So for every 3 stocks going up, 4 were going down.
Roughly, yes. It's a clear sign that whatever minimal rally we saw was driven by just a handful of megacap names. The vast majority of the market was quietly selling off.
And we saw that rotation you mentioned in the sector leaders. Materials led, plus 0.59%, followed by real estate and then tech.
And that tech gain at 0.16%, it was really boosted by NVIDIA after a licensing deal. It wasn't a broad sector rally at all.
No. And on the downside, consumer discretionary lagged the most at negative 0.44%, joined by energy and financials. The whole rotation was dictated by those big commodity themes.
And concerns over the health of the consumer.
Okay, moving over to fixed income. Treasuries were quiet, but we saw what's called a modest bear steepening. Why does that matter?
So we saw the short end stay pretty anchored. The 10-year yield was unchanged at 4.140%. But the longer end saw some selling pressure. The 30-year yield rose 2 basis points to 4.820%.
So the curve got steeper.
A bear steepening, yeah. It suggests two things are happening at once. First, the market is pricing in fewer near-term Fed cuts. Futures now show an 85% probability of no change at the January FOMC meeting.
Then second.
Second, investors are demanding a greater term premium, extra compensation to hold those longer dated bonds because of lingering inflation and supply concerns.
So even though the Fed cut rates 3 times in 2025, the market thinks the easy cuts are over for now.
That's the takeaway. The Fed's been very clear about being cautious, and the long end of the curve is reflecting that uncertainty.
Now let's get to what I think is the massive disconnect of the day. VIX versus gold.
The ultimate paradox.
We just detailed how gold and silver are surging on what we're calling safe haven fears, geopolitical tension. So if fear is driving these huge inflows, why is the VIX, the market's fear gauge, so suppressed?
This is the thing that should concern every investor. The VIX closed at 13.60. It was only up a little bit today, but it remains 24% below its 50-day moving average.
And is basically sitting near its 52-week low.
Right near it. The low is 13.38. And the thing is, haven flows into precious metals and suppressed implied volatility. They rarely, if ever, coexist for long.
They're contradictory signals.
Completely contradictory.
So who's lying to us? Is the VIX, which represents the cost of, stock market protection, is it completely mispricing risk? Or are the gold and silver moves just an isolated trade?
That is the million-dollar question heading into the new year. The VIX often reflects short-term complacency, especially in thin holiday trading.
Right.
Gold, on the other hand, tends to move on deeper macro geopolitical concerns that take longer to resolve. If the VIX stays this low while gold tests, say, $4,600, one of those assets is fundamentally wrong about the path of risk in early 2026.
That level of complacency just feels misplaced given the volatility we're seeing elsewhere.
I agree.
Let's briefly touch on currencies, because we saw some paradoxes there too, with the dollar and the yen.
The dollar index, the DXY, it only edged up 0.06% to 98.04. But the bigger picture is the annual trend.
It's been weak all year.
The DXY is still down nearly 10% year to date. That puts the dollar on track for its weakest annual performance since 2017.
And then there's the yen. The Bank of Japan finally hikes rates and the market just shrugs.
It's a huge paradox. USD JPY rose 0.25% today to 156.56. This is happening even though the Bank of Japan just hiked its policy rate to 0.75%, the highest it's been in 30 years.
So why is the yen still getting weaker?
The market is effectively ignoring the central bank because Governor Ueda's forward guidance was so vague, it suggests they're reluctant to follow up with more aggressive hikes.
And that 156 level,
Yeah.
that's getting dangerously close to that intervention territory we've been watching.
Absolutely. We're approaching the 158 to 160 warning zone. The last time we got near there, Japanese authorities stepped in a big way to strengthen the currency.
It's a major vulnerability traders are testing to end the year.
Definitely.
Finally, let's look at crypto. Very subdued action, which feels like the calm before a storm.
It certainly does. The caution is palpable. Bitcoin slipped a bit, 0.50% to $87,450.
But everyone is just waiting for Friday.
The entire crypto community is fixated on Friday. It brings the single largest Bitcoin options expiry in history by notional value.
How large are we talking?
$23.7 billion. With BTC dominance so high at 75.27%, analysts are projecting potential price swings of 5 to 7% after that expiry. The market is just holding its breath.
So wrapping up this session, December 26 was anything but quiet. We had the extreme commodity divergence, the metals melt up versus the energy collapse,
We had small caps signaling clear risk aversion.
and that massive persistent contradiction between the VIX and gold.
And we're heading into the final 3 trading sessions of 2025, still inside that seasonal Santa Claus rally window, but the internal pressures are immense.
So what are the key levels you're monitoring?
Well, if the geopolitical tensions keep escalating, gold has a clear path to test that $4,600 to $4,700 resistance zone.
And in crypto?
That Friday options expiry is everything. A definitive break below $85,000 in Bitcoin after that would signal continued weakness.
And that brings us back to the biggest question of the day.
The VIX gold contradiction.
Can this market complacency, signaled by that low VIX, can it really persist when genuine safe haven assets are rallying so explosively on real, deep concerns?
It's an unsustainable tension. It is. And how that tension resolves is the ultimate driving force we're taking with us into 2026.
All right, I think that covers all the key movements for today.
It was a busy session beneath the surface of those flat indices.
Yeah, it really was. That's the daily consolidation for today. And as always, remember this is informational and educational.
Not financial or investment advice.
Definitely not. Do your own research before making any moves. But if you found this breakdown helpful, hit that subscribe button. We're here every trading day after the close.
See you next time.